It's Saturday the 17th of July 2021. Evolution Mining released their June quarterly report on Friday. It was pretty negatively received by the market, and I'm just going to talk about a few things that I noticed in here. I don't hold the stock. I haven't held it for probably the last 18 to 24 months, and I'm seeing a few sort of ominous signs in here, perhaps, that remind me of some of how the other ASX gold producers have fared over the last kind of 12 to 18 months. So first thing, group gold production, 169,000 ounces, which was a bit of a miss on the quarterly number, which I'll talk about. All-in sustaining cost $12.39 per ounce, $9.54 US equivalent. I noticed this statement here, sector-leading cash generation. I see companies make statements like this often and not really back them up. And I think Evolution is in a way living off a bit of past glory. There's no doubt that 3 or 4 years ago that was true, that it was a sector leader in cash generation, both on the ASX and internationally as well. But I think over the last few years, costs have really crept up quite substantially. It used to be well under 1,000 Australian dollars an ounce, probably back in 2017-ish, and now we're up to 12.39. And this is pretty similar to how a company such as like a Regis has evolved, St. Barbara, even Northern Star. We've seen costs creep up quite substantially in the last few years. So to say sector-leading cash generation, and I look at a lot of these reports, and I see companies trading on a lot lower multiples. I see companies like SSR Mining, for example, producing equivalent cash flow and having trading at valuations probably 50% less than what Evolution is trading at, with, I think, as good a growth prospects and better mines in many cases as well. So Evolution saying these statements and not really backing them up, I think it's really, they're burning some of the goodwill that they've probably built up, and that's, I think that might be tested in the next 6 to 12 months with some of the numbers in here, which I'll go into. The quarterly number, I mentioned that I think it was a bit of a miss. They stated in here, there are 681,000 ounces there, if you round it up for the full year number, which was in the original guidance range, but they decided to tighten the guidance range at the end of the March quarter to 695 to 710, which in effect, they'd produced 511,000 to the end of March. So what they were saying was they were going to produce 184,000 at the low end to 199,000 at the high end in the June quarter. What we ended up getting was 169. So we got 15,000 ounces below the low end of the guidance range for the June quarter. So that's a pretty substantial miss. But what annoys me here a little bit is they said 2% below the full year guidance range. But when they set that guidance range, they'd already produced 511,000 ounces. So they should have had a greater level of accuracy than missing that number by sort of 10 to 12% for the June quarter. But to say 2% of the full year number is a little bit disingenuous. It's and they know that they could have quite easily stated the June number in here and said they miss on the June number was 12% or 10% below the bottom end, but they haven't, and that kind of it's not manipulation or incorrect, but it's just showing statistics in a quite a favorable light, and that sort of stuff. When companies start doing that, it can be a bit of a warning sign as well, potentially. I think Evolution's always been quite open with how they've presented information, and I think that statement there didn't sit too well with me. Major capital, another item, $274 million for the full year. They are spending a lot of capital at the moment, and that's only going to increase going forward. So even though if you have your all-in sustaining cost at $12.39, when you're spending another $260 to $290 million, or 274, which is equivalent, to what's that? Another $400 an ounce they're spending on major capital, roughly for the full year. So pretty substantial capital commitments there. Another warning sign. You're spending a lot of capital and your costs are not really going down. I think the market probably didn't like the dividend being it was 7 cents in the last payment. Probably was in March or April, I think, but now they're guiding toward a 4 to 6 cents for the final dividend payment. So that's a pretty substantial cut there. I don't know how many people are owning Evolution for the dividend, but they had sort of said that they're a good dividend payer, but and that's been challenged here. And I think once these numbers start to get cut, and with that substantial capital commitments they have in the next few years, it's probably a more sustainable rate of dividend. And this is pretty similar to what we saw with Regis when they cut their dividend probably 6 or 9 months ago, when the market didn't really like that too much. So group operating mine cash flow, we've seen that trend down gradually. It was up on the previous quarter, but partly this is due to the gold price, but it's not a great trend. So we've had the gold price fall in the last 6 to 9 months in Australian dollar terms, and then we've also had their costs creeping up in the last 6 to 9 months too. So that's not all that attractive, direction. I see here that also Cal had a 12-day mill shutdown, unplanned mill shutdown. So that's equivalent to, 12 or 15% of the days of the quarter where we had a mill shutdown. So I guess that probably accounts for some of that miss on the production number of, they missed by about 15,000 ounces from their June range. And this probably accounts for almost half of that. So that was, I guess, a bit of a negative there. Red Lake, again, 30,000 ounces of gold and all-in sustaining costs, $22.33 an ounce. I'm still skeptical of this whole acquisition. There's a lot of money being spent here. They haven't really been profitable since they acquired it. It's quite positive, some of the language in here, and gradual improvement quarter on quarter. Ore mines steadily increase throughout each quarter in FY21, with the June quarter 63% higher than the September quarter. This demonstrates the progress made since the acquisition and the operations production capability. But then when you look at the actual cost performance, the June quarter was the highest of the year. I don't know if there's a timing issues there or anything, but the fact is we're still sitting at costs that are, when you put it onto an all-in cost basis, the mine is not profitable at the moment, and a lot more money has to be spent to make it profitable. And I just don't understand why they went for this kind of, really a lot of money, a lot of capital has to be spent here. There's a lot of risk involved. It's underground. It just seems like a bit of a questionable acquisition for me, but obviously we still need to wait longer for all that capital we spent to see what can be delivered on the end. But I think there's still a little bit of jawboning here to sort of convince the market of the quality of this asset, when the numbers it's not showing through in the numbers yet. And I'm skeptical it will show through after all the capital that needs to be spent as well. So I didn't like the Pogo acquisition that Northern Star did either. And I think this is sort of trending in the same direction, just these significant projects that need to be, years worth of capital commitments. You're not being profitable in the meantime. It just seemed like a bit of a questionable acquisition for me, and that's one of the reasons why I've sort of avoided Evolution for the last year or two. Mungari was a very good asset in FY19 and 20. I think its costs were steadily decreasing. Production was increasing. They said here lower production this quarter was, so they've got all-in sustaining costs there, $1,900 an ounce. Lower production was a result of issues with stope performance in the Frogs Leg underground mine. A stope improvement plan has been initiated. There's not a whole lot of detail there. When I look at the cost performance, you can see what I was saying, that we've been trending badly all year. Every quarter down on the last, cost increasing all year. So not a great cost trend there either. This was kind of the third asset of the company, probably before they acquired Red Lake. It was Cowell, Ernest Henry, and then Mungari as well. Ernest Henry, I skipped over that. That's been a star performer again. Production a little bit down, but the copper price has gone, particularly in that June quarter, went a bit nuts. And they get all the copper credits there. So this is negative all-in sustaining cost. Pure. It's just a cash machine at the moment, Ernest Henry. And that deal was a extremely good one when they did it a few years ago. And probably I think all that, the quality of acquisitions they were able to do in that sort of FY15 to 18 period has sort of that's why they've built up that reputation as sort of the best in class and sector leading cash flow and all these sort of statements. But to me, it's not it's not been borne out by recent results, and the trend is not positive. These Queensland assets, again, they produce better numbers this quarter than they have previously. Mount Rawdon, I was looking in here, that was a decent number. That's sort of a higher throughput, lower grade operation, ore processed, 860,000 ounces, 0.84 grams. That was a significant improvement over the previous quarter. Cost performance there has been a little bit up and down all year. They also had some issues, I think, in the previous quarter with production. Mount Carlton had a much better numbers than the previous 3 quarters. I'm not sure how sustainable that is going forward as well. If we're going to trend back more toward these numbers than have a better quarter like this one. So Mount Carlton's been a bad performer all year, and these assets, I think for a company the size of Evolution, are not really of scale, and the reserves are a bit short, which I'll talk about too. So they took on quite a bit more debt to fund the acquisition of Battle North, which is the Canadian junior bolt-on to Red Lake, that they're going to use that to expedite production improvements, I think, at the Red Lake mine. So they're back to a net debt position. I don't have any problem with that. They don't have a huge amount of debt. But if you want to look at this in the multiples versus other companies, you need to assess that debt position. Many other companies of this scale on world markets, something like SSR Mining or B2 Gold, do not have any debt. They're sort of got $500 million in the bank, roughly, in net cash. So, as I said, the debt doesn't worry me too much, but it's the trend is not positive. We see here Ernest Henry, like I said, was the one that's really generating a lot of the cash flow. Everything else, not that great. Red Lake negative, Mungari negative cash flow for the quarter. Cal pretty minimal amount, but huge capital commitment there. And the Queensland assets did okay this quarter, but not that great previously. So you can see there that trend throughout the year, just trending down all year with net mine cash flow. And as I said, I don't think they are a sector leader anymore on that metric. So that quarterly was pretty weak. I think the other thing in here was the production announcement, the growth outlook. So they've given some guidance for the next 3 years, 670 to 730 next year. So basically in line with the FY21 numbers, and then creeping up gradually after that by another sort of 80,000 ounces to 100,000 ounces, and then again in FY24. So settling on another, potentially probably in that order of about 220,000 ounces of extra production there is the target over the next 3 years, which, it doesn't sound too bad having that growth. But I guess it always comes down to cost. What's the cost of that growth? We've seen here so that they've approved the Cal Underground project, $380 million in capital required for pre-production. Pretty significant commitment there. 15% internal rate of return. That's a pre-tax number. That's a pretty marginal project, I would have thought. And it's questionable to me why they've gone down this route when these numbers are not all that great. They are using a $2,200 gold price there, which is probably more aggressive than Evolution has previously used for a lot of their projects. And it just feels like they're reaching a little bit here. We can look at it in two ways. If you compare it to how Regis went with their Tropicana acquisition, that was obviously viewed by the market as a bit of a negative. They overpaid. But I think Evolution is sort of probably doing the metrics here are not much better than what was used for that Regis acquisition in terms of how much you're paying for that extra growth. What's the capital commitment here? So I'm not really sure why they've gone down this path. 8-year payback period as well, quite long. So it's not all that attractive project from what I can see. And when you're mining 2.5 grams. Underground as well. If there's any problems with the reserve model, and you miss on the grade by, you're only getting 2.2, 2.3 grams, the economics probably start to fall apart fairly quickly. If you're moving a lot more dirt, and this is a pretty significant underground we're talking here. So it just seems like a project that's not all that higher quality. And the other thing they're going for is Red Lake, doing a lot more work at Red Lake. They said here stage 1 transformation plan ahead of schedule, produce over 200,000 ounces a year at an all-in sustaining cost of $1,000 per ounce by the end of FY23. At the moment that seems quite a way off. Where with all-in sustaining costs currently probably pushing 1,500 US. So a lot more work needed to get it within that target, and they've said ahead of schedule. I'm not sure what that schedule looks like. So I'm a little bit skeptical they're going to reach that, but we'll wait and see. So this is probably the main thing here, the main slide, the crux of the issue, the capital required over the next 3 years. What's that? 470 at the 475 at the midpoint there, and then another 525. So and then another 320. So what's that? 1.3 billion Australian dollars over the next 3 years to achieve that 220,000 extra ounces of production. So I don't know what Regis ended up paying for the Tropicana acquisition for sort of 150,000 ounces. They've ended up paying, I think, in that order of about 900 million Australian dollars. So on an ounce basis, I think this capital commitment required here probably in the same sort of ballpark, and probably the quality of ounces that are being acquired might be lower. I think the quality of these sort of growth ounces, particularly at Red Lake, probably not quite as good as at Tropicana for Regis. So I see this as kind of the alternate path for Regis that Regis took. They're going for the sort of organic route, but it's still, I think there's a lot of cash has to be spent here, and there is a risk to these numbers. And I think the other thing, I had a couple of other highlights in here. I had a couple of other points in here that if we look at some of those marginal assets in Queensland, Mount Rawdon there, you can see it's reserve grade, 0.62 grams a tonne, and it's been mining at the moment. I said they're mining there at, 0.85, I think. So they're considerably above the reserve grade at the moment. I don't know how well the costs are at a grade of, if you start to trend toward that reserve grade, if the costs really ratchet up to another, get up to sort of $1,500 an ounce Australian sort of levels. It's not a great asset. Mount Carlton has only got 311,000 ounces in reserves. So again, fairly short mine life. So I guess what I'm saying here is that the production outlook for Regis is really achieving these numbers is really dependent, I think, on those assets continuing to deliver at those numbers and not being sold off or anything. It's almost like, I think the way Evolution's behaved previously is that they've sold assets when they get to those sort of levels. So there's probably a good chance in the next 3 years that both of those assets are no longer on the Evolution list of mines. So they're almost replacing production here with some of this growth. So it's almost, this outlook assumes sort of flat forecasts, I think, for those operations. But you wonder how well if those operations can continue to be in the Evolution portfolio. So this extra growth is almost, some of it will be accounting for those other mines probably sort of reducing in quality gradually and running out of reserves. I think they have said that they're looking at extending the mine life at I think it's Mount Carlton. They've got that Crush Creek project. Haven't looked into it too much, but I just feel like it's all a bit hard for Evolution, and we're seeing the similar story play out here to how we've seen charts like Regis play out and St. Barbara. Evolution, I think, still had that goodwill of the market, that best in class feel to it. It was the go-to gold stock. If you didn't want to touch Newcrest, you just bought Evolution as your gold sector exposure. I think there's a real risk here that we start to see that trade unwind. And this might be the first part of it, with no growth in the next 12 months and significant capital commitments. And I think there's risk behind some of those numbers as well. We've seen all-in sustaining costs, they've been creeping up, as I said, and they've been missing a lot of numbers previously in the last sort of 12 or 18 months, when before that they would very rarely miss production forecasts. So we're seeing a bit of definitely has got echoes of how Regis has performed in the last 2 or 3 years. And I think the chart has, I think there's more room to fall here, to be honest, on the Evolution chart. I don't think this is going down to $2 a share or anything like how Regis has done, or $2.50 or whatever they're trading at now. But it's definitely, I think there's Evolution's probably held up better than something like Regis. If we look at the Regis chart, how that performed, I'm out of that stock now, but once we sort of broke down here, then it's just fallen rapidly. I feel like we're sort of in this period here. Forget about what happened in the COVID period, but where I think there's a good chance that Evolution share price falls, significantly from here, well below sort of $4. I think is possible. So it's just not a stock that I'm very attracted to at the moment. I think there's better value in some of the other, particularly in some of the TSX probably equivalent companies. Even Northern Star, I think, is probably a little bit more value in that portfolio, where they don't need perhaps as much growth capital to achieve extra production in the next few years. So I'm a bit negative on Evolution at the moment. They definitely have been a good performer in the last 5 years, but we've seen, as I said, those previously good performers like St. Barbara, Evolution, Regis, Northern Star have been really struggling in the last 12 months. And that's not just because of the gold price going down a little bit and sort of consolidating. It's because of fundamental issues in some of the production profiles for these companies, and that the assets that they were living off very well, that they acquired in the downturn in 2014, 2015, are not performing at the same levels anymore. And we're seeing cost pressures as well. So I think you've got to be aware of these trends and not be fighting them too much. And I tried to fight that trend with St. Barbara and Regis too much. Even though I noticed a trend there, I thought, these companies have always been good performers. They'll come back, but they haven't. They've continued to have more performance issues. So I don't want to get caught out owning Evolution here and seeing that where I'm sort of banking on a past glory to help future production, when I can see that the physical trends and cost trends are not positive. Thanks very much.